Yesterday, of course, that was the big CPI report coming in a bit cooler than expected. And does that change the Fed's outlook on rate hikes of 1, 2, or more? Does that decline in CPI yesterday have much to do with that? Here's what you need to know before the bell this morning. Yesterday, we talked about the CPI report, and we said if the CPI report comes in hotter than expected, we could expect up to a 1 to 1.5% decline in the market. If it comes in weaker than expected, we could see as much as a 1 to 1.5% rise in the markets yesterday, and that rise would break us out of this consolidation range that we have been in. And of course, that's exactly what happened yesterday. The CPI number came in at 0.2 versus 0.3. That dropped the overall inflation rate to 3% on a year-over-year basis. That was the juice the markets needed to say, okay, the Fed's done hiking rates. If they hike rates in July, that'll be their last rate hike. That pushed the markets up above that breakout trading range. So here we are. We've now had a consolidation range. We were on a sell signal, and we've broken out to the upside of that. And of course, this is about to flip the sell signal that we've had over the last few days, actually the last couple of weeks, back to a buy signal. This is going to push the markets higher. Market futures are pointing higher this morning. We're up about 100 points on the NASDAQ, about a good 16, 17 points on the S&P. And of course, that's going to be mostly tech driven today, with the Dow kind of lagging the open this morning, only up about 56 points. But again, we have kind of been consolidating here for the last week or so. This breakout is going to give the market some room to run here. And there's not a lot of resistance between here and all-time highs now. So while Goldman Sachs is starting to talk about all-time highs, the reality is there's not a lot to stop the markets at this point from reaching all-time highs. We're in the seasonally weak part of the year, of course, with summer. So again, if you take a look at the put-call ratio, it is put-hate all across the board. Nobody believes this market is going to have a decline whatsoever. And generally, when you get a big divergence between the market and the number of puts, that's generally a good contrarian indicator. You're going to get at least a short-term correction. Still think that's real possible sometime this summer. But by the time we get to October, November, December, we could very well be talking about a rally back to all-time highs. So again, there's really no reason to be overly negative in the markets right now. Use dips as an opportunity to increase some exposure to some degree. Get your portfolios kind of aligned with where you want them to be. The time to be uber negative was behind us. That's kind of been over now for a while. Still a lot of concerns out there, of course, about recession and other stuff. Hey, I get it. Markets looking well past that now. In fact, if you take a look at the markets and sentiment versus economic indicators, they're leading those indicators right now. And we're going to start to see, as we saw with the ISM Services Index, begin to see some of those more negative economic indicators start to now turn positive. Sentiment's rising across the board. Both consumer expectations are rising, as well as current and coincident sentiment. That's rising as well. Not surprising. That's that wealth effect kicking in here from the markets. Again, something we'll talk about with Michael Leibowitz, certainly working against this Fed's idea of quelling inflation, but with the inflation data coming down now, there doesn't really seem to be a lot to keep the markets back at this point. And again, there's a lot of capital still needs to come into the markets. A lot of investors now on the sidelines needing to chase this market higher. But again, doesn't mean that we're not going to have some corrective action along the way to allow you to get your portfolios back in line with the markets if you need to do that. We're working on that steadily here because we've been underweight equities through the first part of this year. We definitely have to get those portfolios in line with the markets as well. That's going to be the challenge we're working on this summer. That's what you need to know before the bell.